The stock market is not a casino, a game, or a place for quick riches. It is a highly structured, regulated, and essential component of modern economies. At its core, the stock market exists to connect companies that need capital to grow with individuals and institutions willing to provide that capital in exchange for partial ownership. When you buy a share of stock, you are not purchasing a lottery ticket, you are becoming a fractional owner of a real business, with rights to a portion of its profits and assets. This mechanism allows companies to expand without taking on debt, and it allows investors to participate in the growth of the economy through ownership. The stock market also serves as a barometer of economic health. When businesses are performing well and future prospects are strong, stock prices generally rise. When uncertainty or recession looms, prices tend to fall. It is crucial to understand that price fluctuations are not random. They reflect collective expectations about future earnings, interest rates, geopolitical events, and macroeconomic trends. Many beginners mistakenly believe the market is driven by emotions or manipulation, but while sentiment plays a role, fundamentals, revenue, profit margins, debt levels, and competitive positioning are what ultimately determine long-term value. The stock market is global, with major exchanges like the NYSE, NASDAQ, B3 in Brazil, and others operating under strict regulatory frameworks to ensure transparency and fairness. Ignoring this structure leads to poor decisions. Successful investing begins with respecting the market's purpose and mechanics. Before you invest a single dollar, you must internalize that the stock market is a tool for wealth creation over time, not a shortcut, and treating it as anything else is the first step toward losing money. When a company decides to go public, it undergoes an initial public offering, a complex process regulated by financial authorities like the SEC in the United States or the CVM in Brazil. During an initial public offering, the company works with investment banks to determine how many shares to issue, at what price, and how to distribute them to initial investors. These shares represent equity, actual ownership stakes, and each share gives the holders certain rights, including voting in shareholder meetings and receiving dividends if the company chooses to distribute profits. Not all stocks are the same. Common shares typically offer voting rights but variable dividends, while preferred shares may offer fixed dividends but no voting power. The value of a stock is not arbitrary. It is derived from the company's book value, assets minus liabilities, its earnings potential, and market sentiment. A company's market capitalization, share price multiplied by total shares outstanding, determines its size category, small cap, mid cap, or large cap, each carrying different risk and growth profiles. Stocks also come with different classes. For example, Google's Class A shares have voting rights, while Class C shares do not, despite representing the same economic interest. Understanding what you own when you buy a stock is critical. You are not buying a ticker symbol or a chart pattern. You are buying a piece of a business with real employees, products, competitors, and financial statements. Many investors lose money because they treat stocks as abstract numbers instead of real companies. This mindset shift is non-negotiable for long-term success. Always ask, what does this company do? How does it make money? Who are its customers? What are its risks? If you cannot answer these, you are not investing, you are gambling. One of the biggest mistakes beginners make is underestimating, or completely ignoring, the real costs involved in stock trading. These costs include brokerage commissions, exchange fees, custody fees, spreads, and even taxes, all of which eat into your returns over time. While many brokers now advertise zero-commission trading, that does not mean trading is free. They often make money through payment for order flow, wider bid-ask spreads, or premium services, which can indirectly cost you more. The bid-ask spread, the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept, is a hidden cost that can be significant in low-volume or volatile stocks. Custody fees, charged annually by some brokers to hold your assets, can also add up, especially if you are investing small amounts regularly. Taxes are another major consideration. In most countries, capital gains from stock sales are taxable, and dividend income may also be subject to withholding or income tax. Failing to plan for this can turn a profitable trade into a net loss after taxes. Currency conversion fees matter too if you are investing in foreign markets. A 1% fee on each transaction may seem small, but compounded over dozens of trades, it becomes material. The key to minimizing costs is choosing the right broker, compare fee structures, Read the fine print and prioritize platforms with transparent, low-cost models. Avoid frequent trading. Each buy and sell order adds costs. And for long-term investors, turnover is often the enemy of compounding. Use limit orders instead of market orders to control the price you pay and avoid slippage. And finally, automate your investments where possible. Recurring purchases reduce emotional decision-making and often come with reduced fees. Remember, in investing, costs are one of the few things you can fully control. Manage them wisely, or they will quietly erode your wealth. Opening a brokerage account is the gateway to the stock market, but not all platforms are created equal. Choosing the wrong one can limit your options, increase your costs, or expose you to unnecessary risks. Start by determining your investor profile. Are you a long-term passive investor, an active trader, or someone interested in international markets? This will dictate which features matter most: low fees, research tools, global access, fractional shares, or educational content. In Brazil, platforms like XP, Rico, BTG Pactual, and Inter offer different advantages. XP has a vast product catalog. Inter offers zero custody fees. BTG provides strong research, and Rico is user-friendly for beginners. Globally, brokers like Interactive Brokers, TD Ameritrade, or eToro serve different needs. Interactive Brokers is powerful for advanced traders, while eToro is social and beginner-focused. Before signing up, verify that the broker is regulated by a reputable authority. In Brazil, check if they are registered with the CVM and B3. Internationally, look for SEC, FCA, or ASIC regulation. Security is non-negotiable. Ensure the platform offers two-factor authentication, encrypted transactions, and SIPC or equivalent insurance to protect your assets in case of broker insolvency. Consider the user interface. If it is confusing or glitchy, you will make mistakes or avoid using it altogether. Look for educational resources, webinars, tutorials, market analysis, especially if you are new. Check withdrawal policies and processing times. Some brokers take days or charge fees to return your money, which is unacceptable. Avoid brokers that push proprietary products or high-commission investments. Your broker should be a neutral platform, not a salesperson. Finally, start small. Fund your account with an amount you are comfortable losing while you learn the ropes. Your brokerage account is your command center. Choose wisely, because switching later can be time-consuming and costly. Stock analysis falls into two broad categories: fundamental and technical. But not all methods are equally useful, and many beginners waste time on approaches that do not drive long-term results. Fundamental analysis involves evaluating a company's financial health, business model, industry position, and growth prospects using data from financial statements, management reports, and economic indicators. Key metrics include price-to-earnings ratio, return on equity, debt-to-equity ratio, free cash flow, and earnings per share growth. These tell you whether a company is undervalued, over-leveraged, or growing sustainably. Technical analysis, on the other hand, studies price charts, volume patterns, and indicators like moving averages or RSI to predict short-term price movements. While useful for traders, it has limited value for long-term investors because it ignores the underlying business. The truth is, fundamentals drive long-term value. A company can have a bullish chart pattern, but go bankrupt if its business is broken. Conversely, a bearish stock can multiply in value if the company executes well over years. Beginners often obsess over candlestick patterns or momentum indicators, but these are noise compared to understanding whether a company has pricing power, a durable competitive advantage, and scalable profits. Always start with the annual report. Form 10-K in the United States or DFP in Brazil. It contains audited financials, risk factors, and management discussion that no chart can replicate. Compare the company against its peers. Is it growing faster, more profitable, less indebted? Use screening tools to filter stocks by metrics that matter to your strategy. Do not just chase hot tickers. Avoid analysis paralysis. You do not need to memorize 50 ratios. Focus on 5 to 7 key indicators that align with your goals. And remember, no analysis is perfect. Even the best companies face unexpected challenges. The goal is not to predict the future with certainty, but to make informed, probabilistic decisions based on evidence. If you cannot explain why you own a stock in one clear sentence, based on its business, not its chart, you have not done real analysis. Your first portfolio should not be a collection of hot tips or meme stocks. It should be a deliberately constructed system designed to match your goals, time horizon, and risk tolerance. Asset allocation, how you divide your money between stocks, bonds, cash, and other assets, is the single most important decision you will make, far more impactful than picking individual stocks. A 25-year-old saving for retirement might allocate 90% to stocks and 10% to bonds, while a 60-year-old nearing retirement might reverse that ratio. Your age, income stability, and financial obligations dictate this balance. Within stocks, diversification is your shield against volatility. Do not put all your money in one sector, one country, or one company. If you invest only in tech stocks and the sector crashes, your entire portfolio suffers. If you hold healthcare, energy, finance, and consumer goods, downturns in one area may be offset by stability or growth in others. Geographic diversification matters too. Investing only in Brazilian stocks exposes you to local inflation, currency risk, and political instability. Adding United States, European, or Asian stocks spreads that risk. Position sizing is critical. No single stock should represent more than 5 to 10% of your total portfolio, no matter how confident you feel. Use index funds or ETFs for core exposure. They provide instant diversification at low cost, letting you focus your stock-picking energy on a few high-conviction ideas. Rebalance your portfolio at least once a year. If stocks surge and now represent 95% of your assets when you wanted 80%, sell some to buy bonds and restore your target allocation. Risk management is not about avoiding losses, it is about controlling them. Set stop losses if you trade actively, but avoid them for long-term holdings unless the company's fundamentals deteriorate. Never invest money you will need within 3 to 5 years. Stocks are volatile in the short term. And above all, ignore the noise, media hype, social media trends, and quarterly earnings drama will tempt you to overtrade. Your portfolio is a marathon engine, not a sprint racer. Build it for endurance, not excitement. The stock market does not destroy wealth, human psychology does. Study after study shows that the average investor underperforms the market not because of bad stock picks, but because of emotional decisions, panic selling in downturns, chasing performance after rallies, and overconfidence after a few wins. Fear and greed are the twin engines of financial self-sabotage. Fear makes you sell low, greed makes you buy high, and both guarantee subpar returns. One of the most damaging behaviors is performance chasing, buying stocks or funds simply because they have recently gone up, without understanding why or whether the trend can continue. This is how bubbles form and how beginners get trapped holding overvalued assets just before corrections. Another killer is loss aversion, the tendency to hold losing positions too long because it might come back, while selling winners too early to lock in gains. This reverses the golden rule: cut losses quickly, let winners run. Confirmation bias is equally dangerous, seeking only information that supports your existing beliefs while ignoring contrary evidence. If you bought a stock, do not just read bullish analyses, actively search for bearish arguments and test your thesis against them. Overtrading is another silent wealth killer. Each trade incurs costs, taxes, and emotional stress, and studies show that the more you trade, the worse you perform. Automate your investing, set up recurring buys, use limit orders, and avoid checking your portfolio daily. Create an investment policy statement, a written document outlining your goals, strategy, and rules, and refer to it when emotions run high. Surround yourself with rational voices. Avoid social media stock gurus, Telegram groups, and sure-thing tipsters. And finally, accept that you will be wrong frequently. Even the best investors lose on 40 to 50% of their trades. Success comes not from being right all the time, but from managing risk, staying disciplined, and compounding gains over decades. Master your mind, or the market will master you. Investing is not an event. It is a lifelong process of learning, adjusting, and staying committed to your strategy through market cycles, economic shifts, and personal changes. Your long-term strategy should be simple, repeatable, and anchored in your life goals. Whether that is retirement at 60, buying a home, funding education, or achieving financial independence. Review your portfolio quarterly, not to trade, but to assess: are your holdings still aligned with your goals? Have any companies deteriorated fundamentally? Has your risk tolerance changed? Rebalance if needed, but avoid knee-jerk reactions to short-term news. Continue educating yourself, read annual reports, follow credible financial news, not clickbait, and study market history to understand how cycles work. Avoid lifestyle inflation as your portfolio grows. Resist the urge to spend more. Instead, reinvest gains to accelerate compounding. Tax efficiency matters. Use tax-advantaged accounts where available. Hold investments long-term to qualify for lower capital gains rates. And consider tax loss harvesting to offset gains. Prepare for black swan events, pandemics, wars, crashes, by maintaining an emergency fund and never investing money you cannot afford to see decline temporarily. Remember, time in the market beats timing the market. Missing just the 10 best days in a 20-year period can cut your returns by more than half. Stay patient. Wealth is built in decades, not days. And finally, if this guide helped you understand the stock market with more clarity, realism, and confidence, do me a favor, like this video, subscribe to the channel, and hit the notification bell so you do not miss our next deep dive into ETFs, dividend investing, or how to read financial statements like a pro. Leave a comment below. What is the #1 question you still have about investing? I read every single one, and your feedback shapes our next videos. Share this with a friend who is thinking about investing. Knowledge grows when shared. Thank you for watching. Stay disciplined. Stay patient. Your future self will thank you.